There is an account in Canada that gives you a tax deduction when you put money in, just like an RRSP, and then lets you take every dollar out completely tax-free when you buy your first home, just like a TFSA. It's called the First Home Savings Account, and most Canadians still haven't opened one. The federal government launched it in April 2023. It has been available for over 2 years, and yet the majority of eligible Canadians have either never heard of it or heard of it and assumed it was too complicated to bother with. It is not complicated. It is the most generous first home savings tool this country has ever offered. I'm going to show you exactly how it works, who qualifies, how to stack it with another program for even more tax-free purchasing power, and the one mistake that costs people thousands before they even realize the clock has started. This isn't financial advice, just the mechanics and the math. Let's start with what makes the FHSA different from every other account you've seen. In Canada, savings accounts generally do one of two things. An RRSP gives you a tax deduction when you contribute. A TFSA lets you withdraw tax-free. The FHSA does both at the same time for a first home purchase. Put in $8,000, you get to deduct that $8,000 from your taxable income this year. If you're in a 30% combined tax bracket, that's $2,400 back at tax time. The money then grows inside the account tax-free. And when you pull it out to buy your first home, you pay zero tax on the withdrawal. Zero. That combination, deduction in, tax-free out, does not exist anywhere else in the Canadian tax code. Not in the RRSP, not in the TFSA, not in the RESP. The FHSA is purpose-built for one thing, and within that purpose, it is exceptionally well designed. Now let's talk about who qualifies, because this is where a lot of people stop reading and assume it doesn't apply to them. To open an FHSA, you need to be a Canadian resident, at least 18 years old, and a first-time home buyer, meaning you have not owned a home that you lived in at any point during the current calendar year or the previous 4 calendar years. That last part is more generous than most people expect. If you owned a home 5 or more years ago but have been renting since, you qualify. If your spouse or partner owned a home but you didn't, you may qualify individually. The 4-year look-back is the rule, not a lifetime ban on ever having owned property. The annual contribution limit is $8,000. The lifetime limit is $40,000. Unlike the TFSA, the FHSA has a carry-forward rule with a ceiling. If you open an account in 2025 and only contribute $3,000, you carry forward $5,000 in unused room. Next year you can contribute up to $13,000. The standard $8,000 plus the $5,000 carried forward. But the carry-forward caps at $8,000 total at any one time. This carry-forward rule has one critical implication. The room only accumulates from the year you open the account, not from 2023 when the program launched, not from the year you turned 18, from the year you open the account. Every year you wait to open one is a year of contribution room you permanently lose. If you haven't opened an FHSA yet and you're eligible, open one today, even if you put nothing in it. The account being open is what starts the carry-forward clock. You can contribute later, but you cannot recover room from years the account didn't exist. Let's look at what the deduction actually does to your tax bill with real numbers. Say you earn $80,000 a year in Ontario. Your combined federal and provincial marginal rate at that income is roughly 31%. You contribute $8,000 to your FHSA. At tax time, that $8,000 comes off your taxable income. 31% of $8,000 is roughly $2,480, back in your pocket. That's not a projection. That's the mechanical result of the deduction applied to your bracket. Do it every year for 5 years and you've received $12,000 in tax refunds on $40,000 of contributions. And that $40,000 plus whatever it earned inside the account comes out tax-free when you buy. The deduction you claimed on the way in is never clawed back. The growth is never taxed. This is not a loophole. It is exactly what the account is designed to do. Now let's talk about the withdrawal rules, because getting them right matters. To make a qualifying withdrawal, the kind that comes out tax-free, you need to meet 3 conditions. First, you must be a first-time home buyer at the time of withdrawal. Second, you must have a written agreement to buy or build a qualifying home in Canada. Third, you must intend to occupy that home as your principal residence within 1 year of buying or building it. A qualifying home is a housing unit located in Canada, a house, condo, townhouse, or co-op share. It does not need to be newly built. You can withdraw from the FHSA and use it toward any first home purchase that meets those conditions. You can also make multiple withdrawals across multiple years as long as each one meets the criteria. There is one timing rule worth knowing. The withdrawal deadline is October 1st of the year after you enter into the purchase agreement. So if you sign a purchase agreement in March 2026, you have until October 1st, 2027 to make the FHSA withdrawal tied to that agreement. That gives you flexibility to time the withdrawal around your closing. Now, the question almost everyone asks: what happens if you never buy a home? You save diligently for years and then life changes. Maybe you inherit a property, maybe you move abroad, maybe you simply decide not to buy. Is the money gone? It is not. Here's what happens instead. You can transfer the entire balance of your FHSA, contributions plus growth, directly into your RRSP or your RRIF. Tax deferred, not lost. And crucially, this transfer does not use any of your RRSP contribution room. The $40,000 you saved in an FHSA lands in your RRSP on top of whatever room you already had. You will eventually pay tax when you withdraw from the RRSP in retirement, but by then you'll likely be in a lower bracket, and the decades of tax-free compounding inside the account will have done significant work. The non-home scenario is not a penalty. It is a tax-deferred transfer to your retirement account. The FHSA has no bad exit. Let's talk about the power move, stacking the FHSA with the RRSP Home Buyers Plan. Most people know about one or the other. Very few are using both together. Here is how the combination works. The Home Buyers Plan lets you withdraw up to $35,000 from your RRSP for a first home purchase, tax-free at withdrawal. But you have to repay it over 15 years or it gets added back to your income. The FHSA gives you up to $40,000 tax-free at withdrawal with no repayment required. Ever. Stack them together as a single buyer and you have access to up to $75,000 for a down payment, $35,000 from the HBP and $40,000 from the FHSA. If you are buying with a partner who also qualifies, that's $150,000 combined, both tax-free at withdrawal, no repayment on the FHSA portion. That $150,000 combined is not a theoretical maximum that requires perfect conditions. It requires each person to have an RRSP with $35,000 and an FHSA with $40,000. Both achievable on moderate incomes over 5 to 7 years of consistent saving. Where do you open an FHSA? Your bank almost certainly offers one. Credit unions offer them. Online brokerages like Wealthsimple and Questrade offer them. The process takes about 15 minutes, similar to opening a TFSA. You need your SIN and basic identification. That's it. What should you hold inside it? The same logic that applies to your TFSA and RRSP applies here. If your timeline is under 3 years, keep it in something stable, a high-interest savings account within the FHSA or GICs. If your timeline is 3 to 5 years or more, a low-cost broad market index ETF gives your contributions a chance to compound meaningfully before you withdraw. The account is not just a savings account, it is an investment account. The more time you give it, the more the tax-free growth compounds on top of the deductions you already captured. A couple who opens FHSAs at 25 and doesn't buy until 30 will have meaningfully more than a couple who opens at 29 and buys at 30. Now the 15-year clock. Your FHSA must be closed by December 31st of the year that is 15 years after you first opened it, or by December 31st of the year you turn 71, whichever comes first. If you haven't used it for a home purchase by then, you transfer the balance to your RRSP or RRF. 15 years is a long time. Most first-time buyers buy well before the 15-year mark. But this rule matters for people who open an account early, in their 20s, and then life takes unexpected turns. The account doesn't last forever, but 15 years of tax-free compounding on $40,000 is not a small thing regardless of how it ends. Let's go back to the single biggest mistake people make with the FHSA, because it bears repeating. Every year the account doesn't exist, you permanently lose contribution room. Not temporarily, not carryable, gone. If the FHSA launched in 2023 and you waited until 2026 to open one, you missed 3 years of potential carry-forward room. You could have been building toward a total contribution of $40,000 faster. You can't recover those years. The room doesn't exist retroactively. The fix is so simple it almost feels anticlimactic. Open the account. You don't need to contribute the day you open it. You don't need a specific savings plan in place. The act of opening it costs nothing and starts the clock. Everything else, how much, when, where to invest, you can figure out after. One more thing worth addressing directly. Some people have heard that the FHSA is only useful if you're definitely going to buy a home. That is not accurate. As we covered, the non-home exit transfers the balance to your RRSP without using contribution room. That is a better outcome than most savings vehicles offer. If there is even a 30% chance you buy a home in the next 15 years, the FHSA is worth opening and funding. The tax deductions you collect while saving are real money you keep either way. The growth compounds tax-free either way. The only scenario where the FHSA costs you anything is if you never open it. Here is the 3-step action plan. Step 1. Open the account this week. Pick your bank, credit union, or online brokerage and spend 15 minutes on it. Even a $0 balance starts the carry-forward clock and locks in your eligibility for this year's room. Step 2. Contribute what you can before December 31st of this year. Any amount up to $8,000 counts toward this year's limit and gives you a deduction for this tax year. If you can't max it, contribute what you can. The unused room carries forward. Even $1 contributed before year-end gives you this year's deduction room. Step 3. Decide where to hold it. If you're buying in under 3 years, a high-interest savings account or short-term GIC inside the FHSA is the right call. If your timeline is longer, a low-cost index ETF lets the contributions compound. Don't leave it in the default cash position at 0%. The FHSA is not complicated. It is an $8,000 a year tax deduction that converts into a tax-free withdrawal for your first home. The government designed it to reward people who start early and contribute consistently. The only way to miss out is to not open one. If you're buying with a partner, have the same conversation with them this week. 2 FHSAs stacked with 2 HBP withdrawals is $150,000 tax-free for a down payment. That is a material difference in what you can afford, what your mortgage looks like, and how much interest you pay over the life of the loan. One final note. The FHSA is still relatively new. Not every financial institution has fully integrated it into their systems or trained their staff on its details. If you call your bank and get unclear answers, ask specifically for the FHSA product, not a general savings account or an RRSP. The government information page at canada.ca is the definitive source for current rules. To recap, $8,000 a year, $40,000 lifetime, deduction on the way in, tax-free on the way out for a first home. If you don't buy, it transfers to your RRSP with no room used. Stack it with the Home Buyers Plan for up to $75,000 per person. Open the account to start the carry-forward clock. Every year you wait is room you permanently lose. If this cleared something up, subscribe. Every week I cover the Canadian money mechanics that don't get explained clearly enough. The real numbers, no sales pitch. See you in the next one.